Right. Okay. Good evening, everyone. Yeah, in the lesson of short-run behavior of perfectly competitive market. Short-run behavior of perfectly competitive market.
Recording in progress.
Right. Last day I explained you supernormal profit, normal profit, and abnormal profit or economic losses. Right. Graphical representation is 3. Okay. Right. And we did some calculations as well. Normal profit past 2010. Last day I completed 2010 A level paper. Shall we do 2019 A level paper question? Page number 40. A level 2019. Right. Let's do it, Lama. 2019. Can you see the screen, Huda?
Yes, sir.
Okay. The diagram below presents a perfectly competitive firm operating in the short run, producing an equilibrium output of 100 units. Producing an equilibrium output of 100 units. Kalana, tell me what is mean by equilibrium output of a perfectly competitive firm? Equilibrium output of a perfectly competitive firm. What is that? Yes. Equilibrium output of perfectly competitive firm. Alana? Yes, you know Buddha. We have discussed this part. What is mean by equilibrium?
Demand equals supply.
No. One firm, Buddha. One firm. Yes, that's market equilibrium. Firm's equilibrium. Firm's equilibrium. MR equal MC. Very good. Very good, Buddha. Yes. Brilliant. Kalana, firm's equilibrium mean firms comes to the firm's equilibrium is where firm maximizes its profit. When firm maximizes its profit, that is called short run equilibrium, right? Or firm perfectly competitive firms equilibrium. Did you get what I said?
Yes.
So remember, equilibrium output of 100 units mean, in bracket write down, this is profit maximizing output level. Profit maximizing. Profit maximizing output level. Profit maximizing output, right? Profit maximizing output level. Then what is the condition for profit maximizing? Yes. So that here you can't use the TRTC approach because TRTC curves are not given. You are given MC, ATC and AVC. Right. So you can't use first approach of profit maximization. You have to use second approach, MR equal MC. Profit maximizing means with 100 units. At 100 units, if it is profit maximizing output level, at this output level, marginal cost and marginal revenue should be equal. Are you okay with that point? So at this point, Lamai, what happens? Marginal cost equals marginal revenue. Marginal revenue mean price of the product. Marginal revenue mean perfectly competitive firm, price and marginal revenue. Are you okay with this, Buddha? Yes. Alana,
Okay.
Okay. Then Buddha, look at output 100 output unit. This is 100 output. This is the at this output level MR equal MC. Come vertically upward, right? Come vertically upward. Come vertically upward. Come vertically upward. Then Buddha, you can see This is the MC curve. You will meet MC curve, right? This is the profit maximizing point. I mean, at this point, puta, marginal cost and marginal revenue curves intersect. Then lamai, it indirectly, question has not directly said that price of the product is 60 rupees. If 100 is the profit maximizing output level, Kalana, how much the price of the product or MR? Yes, this should be the MR curve. This
60.
is MR. Yes, this is the marginal revenue curve or price of the product. Dipna, are you okay with this?
Okay, sir.
Okay නේද ළමයි? ඒ කියන්නේ 100 profit maximizing output එක නම් වෙන්න ඕනි නම් 100 වලින් තමයි MR equal MC touch ඒ කියන්නේ MRX intersect වෙන්නේ එතන ළමයි. clearද? එතකොට 100 එක profit maximizing output level වෙන්න ඕනි නම් when if it is a profit maximizing output level, marginal revenue should be 60 rupees or price of the product should be 60 rupees. Did you get what I said? If market
Yes.
price, yes, if market price was 40 rupees lamai, what would the profit maximizing output level be? Yes, if MR equal 40 rupees lamai, then this becomes 40 rupees becomes a marginal revenue curve. Then you can see with the marginal revenue and marginal cost intersects at this point. It is less than 100 units. So 40, 30 cannot be market prices, right? If profit maximizing output level is 100 rupees lamai, marginal revenue of the product should be 60 rupees. I think it's not put the place. In this question, the first step is to recognize the market price, right? Recognize the market price. Okay. What are the questions, Sudha? What are the questions? First one. Calculate the following at the equilibrium level of output. Equilibrium level of output means 100 units. Total revenue received by the firm, total cost incurred by the firm, total fixed cost of the firm, total economic profit or loss of the firm. Right. I'll give you 5 minutes for the calculate these, answer for these 4 questions. Total revenue at the equilibrium, total cost at the equilibrium, total fixed cost at the equilibrium, and total economic profit or loss. Right. I want you to answer. Okay, the Lamai. Right. 2019 A level. Level 2009. Yes. Now, Lamai, price of the product is 60 rupees. Price of the product is 60 rupees. This is the marginal revenue or price of the product, Lamai. Price of the product. Punara, good evening. We are in the page number 14, 2019 A level. Right. This is the profit maximizing output level, MR equal MC, that is 100 units. They ask the first question, total revenue. How to calculate total revenue, Lama? A total revenue, TR equals price into quantity. Price into quantity. How much the price? Dipna. At profit maximizing output level, how much the price of the product? 60 rupees. Right? So price is 60 rupees multiplied by the quantity. Firm is producing 100 units, Lama. Right? Then so total revenue should be how much? Total revenue should be 6,000 rupees. This is the total revenue of the firm. 2 marks. Right? Second one, the total cost. Part B is total cost. Total cost can be calculated ATC, average total cost into quantity. Average total cost into quantity. Here, Buddha, we need to calculate total cost at profit maximizing output level. Total cost at profit maximizing output level. At profit maximizing output level, which is 100, average total cost come vertically upward until you meet average total cost. Here, Buddha, average total cost is the corresponding average total cost value is 40 rupees. Average cost value is 40 rupees. It's mean at 100 units, average total cost is 40, quantity is 100 units, then total cost should be 4,000 rupees. Total cost should be 4,000. Alan, are you okay?
Okay, sir.
Okay. Punara?
Okay, sir.
Okay, right. Total cost. Third one, Buddha, total fixed cost of the firm. C, total fixed cost. The average here, Buddha, based on, the graph does not show the total fixed cost straight away. No, because these are average values, right? You can calculate total fixed cost using average fixed cost, right? Find the average fixed cost first, right? Here, Lamai, you know that ATC is sum of AFC plus AVC, average variable cost. Average variable cost. Average total cost is sum of AFC and AVC. Okay, the Lamai. Right. Then at 100 output units at profit maximizing output level, average total cost is 60 rupees. At 100 output level, average total cost sorry, average, sorry, yeah, average total cost is 40 rupees now. Average total cost 40 rupees. How much the average? We don't know average fixed cost plus average variable cost. How much the average variable cost at 100 unit lamai? Come vertically upward, then you will meet average variable cost. This is the average variable cost. Average variable cost at average variable cost at 100 output level. Then put that 100 output level, ATC 40, we don't know the value of AFC, AVC is 30 rupees. Then average fixed cost should be how much? 40 minus 30. Average fixed cost equals 10. But question is asking you to calculate average total cost. Very simple. What is the equation, Buddha? Average total cost equals AFC equals, sorry, AFC equals total fixed cost over quantity. Average fixed cost 10 rupees, quantity is 100 units, then we can calculate total fixed cost. Right, 1 into TFC, total fixed cost, 10 into 100. Right, then total fixed cost is how much, Lamai? 1000 rupees. This is the total. That's very simple, Lamai. If there is any difference between AVC and ATC, Buddha, that should be AFC. Here, the vertical gap between ATC and AVC should be AFC. Right? If you want to convert AFC into TFC, Lamai, multiply by the quantity. AFC is 10 rupees. The relevant quantity is 100 units. Then total fixed cost should be 1000. Don't need this, all work in Lamai. 2 marks given. D is the economic profit or loss of the firm. Economic profit or loss. D. Economic profit or loss. Profit equals TR minus TC. We have already calculated both. Right? TR, how much, Lamai? At profit maximizing output level, TR 6000, TC 4000. Then profit maximizing, the profit level at profit maximizing output level is 2000 rupees. Is 2000. Any question? Alana, Dipna, Nara, are you okay with this?
Clear, sir.
Shall we move on? 2019 one, okay. Then Lamai, we have Sudha Yoga. Sorry, this is 2000. Sorry, this is 2019, then 2016 A level. The following diagram shows demand cost. Calculate the profit earned by the firm at output 60. Shall we do this question also, Buddha? Very simple one, 2 mark, 4 mark question. The following diagram shows demand and cost curves of the firm operating in a perfectly competitive market in the short run. Calculate the profit earned by the firm at the market price of 60 rupees. Market price is 60 rupees. Market price is 60 rupees, Lama. Right? Market price is 60 rupees. Punara, how much the MR, Buddha? If market price is 160 rupees, marginal revenue. Adaru. How much the marginal revenue of the product?
160.
160, because price and marginal revenue are equal in the perfectly competitive firm. So MR equals 160. Okay, the Lama. Right. Profit maximize in output. Decide the profit. Where is the profit maximize in output level, Lamai? Profit maximize in output level is the output level at which MR equal MC. If price is 160 rupees, Lamai, this is the MR curve. This is the MR curve. 160 becomes rise or MR. D mean to the demand curve also same. Right? This is price or marginal revenue of the product. Dipna, where is the profit maximize in output level, Lamai? This is
Output
how many units?
40 units.
40. Come vertically downward, Lamai. Okay, the Lamai. Prasputa, mark the point where, you know, MR are equal MC and then come vertically downward until you meet the quantity axis, Lamai. At the quantity axis, there should be a particular quantity. That quantity should be the profit maximizing output level. Here, profit maximizing output level is 40 units. Press question asks, calculate the profit earned by the firm at the market price 160 rupees. Very simple. Write down equation. Profit equals profit equals total TR minus EC. Okay, the Lamai. TR profit equals TR. TR is TR equal price into quantity. Price into, let's be done. I'll use it. I'll do it here. Profit equals TR minus TC. Okay, TR minus TC. Profit equals TR price into quantity. Price into quantity minus TC. TC means the average total cost into quantity. Average total cost into, right. How much the price at profit maximizing, sorry, now market price is 160. Right? Question says that price is 160, then multiplied by how many units are being produced? 40 units. 40 units. So this is the total revenue. This total revenue minus total cost. Total cost. Average total cost is come vertically upward. Then Putha, you will meet average total cost at 100 rupees. Am I correct, Lamai? This is the average total cost. Average total cost at 40 units. So average total cost at 40 units. Then average total cost is 100 into how much, Lamai? 100 into quantity is 40 units. Right. Then Lamai, average, sorry, total revenue should be 4,600.
Recording stopped.
4,600 minus 4,000. How much the profit or loss, Kalana?
2,400
Is it profit or loss?
profit.
Profit. Give me 1 minute, Lamai. Right.
Recording in progress.
Right. Right. Then Lamai, the second question is part B. What is the shutdown price of the firm? Remember Lamai, I haven't discussed this point up to now. What is the shutdown price? Putta, shutdown price is the minimum average variable cost. If price is below minimum average variable cost, firm should shut down its operation now. Right? So that is called shutting down point. Minimum average variable cost. Minimum average variable cost here. Right? In this graph, the minimum average here is the minimum average variable cost here. Look at average variable cost curve. This is the average variable cost curve. This is average variable cost curve. This is the lowest point of or minimum point of average variable cost. This means 40 rupees. If market price reduces less than 40 rupees, 40 or less than 40, firm should shut down its operation. So what is the shutdown price of this firm? Shutdown price should be with the minimum average variable cost. This means according to this diagram, minimum AVC is 40 rupees. So if market price falls below 40 rupees, firm should shut down its operation. Until that point, the firm can, if market price is above 40 rupees or minimum average variable cost, even though there is a loss, even though there is an economic loss, firm can continue its operation with the strategy of loss minimization. Okay, the Lamai. Right. Then answer for second one is 40 rupees. Write down shutting down price. The correct answer for that should be below 40 or below 40. If it is exactly 40, Buddha, that decision is up to the firm. Firm can decide whether to continue or shut down. Right? If it is less than 40 Lamai, no any argument, right? Absolutely, it should shut down its operation. Right? So we can say the shutting down price. So shutdown price is how much Lamai? 40 rupees. Is 40 rupees. Within bracket, write down if the market price falls below 40 rupees 40, firm should shut down. Firm should shut down its operations. එදලම තොට ෆර්ම් එකක් ෂඩ්ඩවන් කරන්න ලොස් තිබ්බයි කියලා ෆර්ම් එක ෂඩ්ඩවන් කරන්න නෑ ළමයි පොයින්ට් එක මතක තියාගන්න. හරි. ෆර්ම් එක ෂඩ්ඩවන් කරන්නේ මොන වගේ වෙලාවකද ළමයි? average variable cost එකවත් price එකෙන් cover කරන්න බැරි නම්. clearද ළමයි? Price is not enough to cover at least average variable cost, not the total cost. No, not the total ATC, average variable cost. Okay. This is the point where firm should shut down its operation. Are you okay with this, Kalana, Dipna, Punara?
Okay, sir.
Right. That's done. Then Lamai, Puta, you can do this 2013 A-level paper question. If I do all questions, nothing will be left you. So this is very good question, Buddha, right? We expect you to explain. This is 4-mark question. Do this question as homework. 2013. Here, no calculation, Buddha. This is theory part, theory question, right? Then continuing production while earning subnormal profit or economic losses in the short run. Very simple, Lamai. Even though firm earns economic losses, if price of the product is more than average variable cost of the production, firm should shut down its operation. Okay, the Lamai. Right. Shall we draw this graph? Page number 16, Lamai. Page number 16. Page number 16. Here the point is, Lamai, remember, hmm, here Buddha, average total cost is greater than price of the product. Average total cost is greater than price of the product. What does it mean, Lamai? Market price or the price of the product is not strong enough to cover for average total cost, but it's enough to cover average variable cost. Price is greater than AVC, right? Losses mean anyway, but the average total cost is greater than price. But if firm's price is greater than average variable cost, even though firm makes losses, firm should shut down. Firm should continue its operation without shutting down. If they shut down, the loss of shutting down the firm will be greater than the loss of continuing the firm. I'll prove that concept now. Right. Within bracket, write down here, Lamai, average total cost is greater than price, but price is greater than average variable cost. How to draw the curve, Lamai? Now you should be able to do it. We have drawn so many diagrams, Lamai. Now you know how it goes. And 1 minute, please. Right. Okay. Right. Draw the average total cost, average variable cost, and marginal cost first. Quantity 0, price, so cost. This is average variable cost. This is average total cost, average variable cost, average total cost. Average total cost. The through minimum points of ATC and AVC lamai, marginal cost curve. This is marginal. Well, okay, the lamai. Now what is the here lamai? The point is firm is making losses. Firm is making losses. It means the price of the average total cost of the product is greater than price of the product, but price is greater than average variable cost. Price of the product is lesser than minimum average total cost. Okay, the lamai. Above the average minimum average variable cost. It means the price should be in between ATC and AVC. In between ATC and AVC. Did you get what I said, Lamai? Okay. Right. This is the price of the product. Price or MR. Price or MR. Okay, the Lamai. Look at the price is below minimum average total cost, but above average variable cost. Okay, the Lamai. Right. Then this is the profit maximized in output level. Profit maximized in output level. Profit maximize in output level. Assume that here quantity is 50 units. Quantity is 50 units. Lamai, this is average total cost at 50 units. Assume average total cost is 100 rupees. Price of the product is 80 rupees. This is average variable cost. Assume that average variable cost is 60 rupees. Average variable cost is 60 rupees. Right? I want you to calculate profit or loss next to the diagram. Calculate the loss. Here there is a loss, Lamai. Calculate the loss. How to calculate the loss, Lamai? TR equals, profit equals TR minus TC. TR, Lamai, price into quantity, minus TC, average total cost into quantity. Price is 80 rupees. Yeah, price is 80 rupees. Quantity is 50 units minus average total cost 100 units. Quantity is 50 units. Lamai. Here revenue 4,000. Total cost is 5,000. Lamai. Look at the board, Lamai. Total revenue is not enough to cover total cost, Lamai. Total cost එක cover වෙන්නේ නැහැ, ළමයි. Total cost එක cover කරන්න revenue එක is not enough. Clear the ළමයි? Revenue is not enough to cover total cost. So firm is making a loss. How much the loss, ළමයි? 1,000. This is called economic loss. Economic loss. 1 minute, please, ළමයි. Look at the board. I want answers, right? Right. Give me 1 minute, please, Sudha. Right. Okay, Lamai. Sorry. Right. Okay, Lamai. Can you hear me? Yes. Alan?
Yes, sir.
Okay. Right. Okay, Buddha. I'll show you the total loss if firm shut down its operation. Right. I want you to calculate loss if shut down. If firm shut down its operation. Right. I want answers, Lamai. Right. If firm shut down, it means Buddha, shut down means no output produced, quantity becomes 0, Q is 0. Dipna, tell me Buddha, if firm shut down its operation, how much the total revenue? Total revenue is calculated price into quantity. Price into quantity. Okay, Dalamai. Dipna, tell me how much the total revenue if firm shut down its operation. If there is no output, how much the total revenue? Kalana, how much the total revenue if firm shut down its operations?
0.
0, Lamai. Why? Because no output, Lamai. Price is 80 rupees. Yeah, market price is 80, but no output to sell, Lamai. And no total revenue. Total revenue is 0. Okay, the Lamai. Then Buddha, we have to deduct total cost. Total cost in the short run, there are two types of cost. Total variable and total fixed. Puta, if firm shut down, Punana, tell me how much the total variable cost? If the firm shut down its operation or if there is no output, how much would total variable cost be?
0.
0, Lamai. If there's no output, Lamai, no need raw material, no need workers, okay, the Lamai, no wage, right? So total variable cost also 0. Kalana, how much the total fixed cost? Can it be 0? At 0 output level, would total cost be 0? Sorry, total fixed cost be 0? Yes or no?
No.
No. They, even though Buddha, there is no output, we have fixed expenses, rent, right? That fixed part of electricity bill, insurance, bank loan, interest, normal profit. Okay, the Lamai. Fixed cost is there. How much the fixed cost in this production process? Here Lamai at 50 units, average variable cost is 60. Average total cost 100. Then Buddha, this gap should be AFC, right? This gap mean 40 rupees. Average fixed cost should be 100 minus 60. Average fixed cost should be 40 rupees, Lama. Then you can calculate average total cost. Sorry, total fixed cost. How to calculate total fixed cost? TFC equal AFC into quantity. AFC into quantity. AFC is 40. Quantity 50. Then Buddha, total fixed cost is 2000 rupees. Total fixed cost is 2000 rupees. So remember, even though output level is 0, Buddha, we have to incur this cost. So even though firm shut down its operation, total fixed cost becomes 2000 rupees. Then total cost in the short run equals TVC plus TFC. Even though TVC is 0, there is a TFC, then total cost should be 2000. Revenue 0, but total fixed cost, sorry, total cost of the firm 2000. Kalana, how much the loss if firm shut down its operation?
2000.
2000. Dipna, tell me, without shutting down, if firm continues its operation, how much the loss? Yes, Buddha, how much the loss?
1,000.
1,000. Then what is the best strategy, Buddha? If you are the, right, assume you are the owner of the business, what would you recommend? To continue the business or to shut down? Yes, Lamai. If you were the owner of the business, what would you recommend?
To continue the business.
Continue the business, Lamai. Why? If you continue the business, loss will be 1,000. If you shut down the operations, Lamai, loss will be 2,000. Kalana, what is the most appropriate strategy in the short run?
Continue business.
Continuing the business, right? So this is called loss of shutting down. Loss of shutdown, loss of continuing. Here, my loss of shutdown is lesser than loss of, sorry, other way. Loss of shutdown is greater than loss of continuing, Lamai. So the best strategy is to continue the operation. This is called the loss minimizing strategy in the short run. Can you draw the curve and do all workings, Lamai? No need all calculation. I wanted to prove the point, Lamai. Why doesn't firm shut down its operation? That's what I wanted to show you. Let me know once you're done.
Sir, do we need to write the calculations in the box?
That in the box footer, I want you to write down only this part. This part. These are additional workings. If you want, you can write it down. Otherwise, forget it. I think it's better to write it down. It's very clear. No need to blindly memorize. Draw the curve next to the diagram. There's a dotted line with the in the dotted line. You can copy that calculation part down. Lamai, let me know once you're done. I'm waiting for your answer.
Done, sir.
Okay. Dipna, Punara?
Done, sir.
Right, next one. Right, so the same point again. Right, next one, Pudha, the shutting down production, not continuing, shut down operation when earning subnormal profit. Right, so we have to shut down Lamai. Right, at which point should firm decide to shut down its operation. That is the idea. Right, very simple Lamai. If price is market price is less than average variable cost of the production, firm should shut down its operation. Is no any point to continue operation any longer if price is not uh, enough to cover even average variable cost. Okay, the llama. Right. Can we draw the diagram? Right. Zero price or cost quantity. Average variable cost. Average total cost is marginal. Now, Lamai, firm is making losses, right? Because we are talking about subnormal profit or economic losses. It's mean price is lesser than average total cost. Now, Lamai, price is lesser than even average variable cost, right? Then no need to think twice. The best option is to shut down. Okay, the Lamai. Right here, Lamai, price is less than average variable cost. This is the price of the product, MR. Okay, the Lamai. Right? Then here MC, this is MR Buddha, this is profit max. No, here actually not profit maximizing Lamai, but anyway, this is the output level. Right? At this output level, Lamai, there will be a huge loss. Okay, the Lamai. This is the revenue. This is assume Buddha, it's 20 rupees, but cost is average total cost is 100 rupees. So this big the area of this rectangle shows economic losses, EL, economic losses. Okay, the Lamai, economic losses. Next to the diagram, write down Lamai. No need calculation Lamai because it's you know, no need to show calculation. It's useless. Right. As market price is not enough, write down no, I'll type it on the document. PDF. Now, shall we move on? Need more time?
Done, sir.
Okay. Dipna, Gunara.
Done, sir.
Right. Next to the diagram, Putha, write it down. Next to the diagram, shutting down. Write down. As market price is not enough to cover, write down as the market price is not enough. Market price is not enough to cover at least AVC lama, average total, average variable cost of production average variable cost of production, the firm will shut down its operation. Firm will shut down its operations. Are you okay with this, Lama? Right. Next point, write down. Another way of saying the same point, you can say the loss of continuing. The loss of continuing production, is greater than the loss from shutting down. The loss from shutting. So here, Buddha, the shutting down operation is the very, the better option. Okay, the Lama. Right. Done. Next point. Oh no, this sorry, I'm sorry. This should come this point come to the second graph. Ne? Sorry, Lama, this point should come here, over here. This point should be second diagram. So, yeah. Okay, I think you got the point. No problem. Right. Okay, Lama. Next point. Remember this point also. Shutdown rule of the perfectly competitive firm. Shutdown rule of the perfectly competitive firm implies that firm should continue to operate if the price exceeds the minimum average variable cost in the short run. A firm should shut down its operation when price of the good is below the minimum level of average variable cost. Okay, the Lama, you know that point, right? There's a MCQ question, sorry, a second paper question, page number 18. Let's do it, Lama. A firm operating in the short run period reports that it is total revenue is 100. Total revenue is 100. Total revenue is 100, Lama. Total revenue is 100. Total cost 120 million. Total fixed cost 80 million. Should the firm stay in the business? Why? Yes, what would you think, Lama? Yes, Lama? total revenue given 100 million, total cost 120 million. Out of 120 million lamai, 40 million is the total fixed cost. Should firm stay in the business? Why? Kalana? Kalana, what would you say, Buddha? What is your answer?
It should stay in the business.
Why?
Because total cost is 120 and fixed cost they say it's 40 million. So the variable cost is 80 million. So that means revenue is still greater than the variable cost.
So firm should stay in the business. Dipna, are you clear, Buddha? Did you get the point?
Yes, sir.
Yeah. Punara?
Yes, sir.
Okay. The here point is lamai. Yeah. Calculate total variable cost. Buddha, you have to calculate total variable cost. Other total variable cost or average variable cost. In this question, Buddha, no average variable cost given. So calculate total variable cost. Remember, Buddha, if you don't look at total variable cost, you can't say whether firm should shut down or should continue its operation. Average, you have to look at average total variable cost or average variable cost. Okay, the lamai. If you are not given total variable cost or average variable cost, calculate it based on given information. Right here, TVC equals lamai. Total cost minus total fixed cost. Total cost minus total fixed cost. Total cost minus total fixed cost. Here, the total cost is 120 million. Total cost is 120 million. Total cost is 120 million minus total fixed cost given 40. Then Buddha, the gap, it's mean 80 million should be 80 million should be 80 million should be total variable cost. So total variable cost 80 lamai. Total variable cost 80 million. Right? Total variable cost 80 million. Total revenue 100 million. And you can see Buddha, the firm can cover total variable cost from its revenue. Because income එක හම්බ වෙනවා ළමයි 100 million. හැබැයි variable cost එක 80. After covering variable cost of 80 lamai, they have something excess as well. Excess how much? 20. That 20 million can be used to cover part of fixed cost as well. Remember that point. I'll repeat one more time. Listen very carefully. After cover, Buddha, this total variable cost mean running cost. It's very practical, lamai, right? If you talk to that farm uncle or the small the business owner, the business owner conducted maybe bakery, okay, the lamai small maybe cultivation, okay, the lamai, if you ask at which point are you going to shut down your operation, Buddha, he won't say this total variable cost. එයා මේවා දන්නේ නැහැ ළමයි. එයා කියයි මහත්තයෝ මේ මගේ මේ අර මොකද්ද කියන්නේ day to day expenses, running expenses ළමයි. The expenses for raw materials are wages, right? If that part is covered, I would continue operation now. That is the 80 million or variable cost is called running cost of the business. Okay, the lamai. Here lamai, after covering total variable cost, firm has something excess 20 million. That 20 million, using that 20 million, firm can cover the part of its total fixed cost lamai. If firm shut down, the total fixed cost will be the loss. Okay, the lamai. But now this using this excess amount after that covering 20 million excess there, using this 20 million, they can cover part of fixed cost as well. Right? So answer is lamai, write down as firm's total revenue. total revenue is enough to cover total variable cost. Total variable cost of the production. Total variable cost of production. Total variable cost of production. The firm should stay. Firm should stay in the business. Our advice is not to shut down. No. Right. Right. Lamai, you can complete this question as homework. 2024. Very creative question. You can do it as homework. Right answer, space given. Right. I'll come to the last point. Normal profit in the long run. Normal profit in the long run. Lamai, are you okay? Need more time? Yes?
Done, sir.
Done. Dipna?
Done.
Right. Lamai, I want to tell you that next Sunday, not this Sunday, following Sunday, 20, not 19, 26. Okay, the Lamai. Puta, you will be given a paper. It's a full paper. There will be 25 MCQs and 5 essay questions. Out of 5 essay questions, you can answer 3 essay questions. Then it will be 3-hour paper. Okay, the Lamai. Will be okay with this, Puta? Yes, did you get the message?
So on 26, I won't be able to join, sir.
Why?
So on 26, I'm having double it exams.
Oh. What about Wednesday of the same week? It's been 29. That is a holiday, but no problem, right?
No problem, sir.
No problem. Deepna, are you okay with 29th?
Sir, I won't be able to attend.
Oh, why? Yes, Puda, why?
We have family function.
29th.
Yes, sir.
When to do? That next week is been first week of August. That Saturday, no, not Saturday. That Wednesday of that week, I think 5th of August.
Can, sir.
Can. Deepna?
Yes, sir.
Okay. No, Punara, you no need to do that paper. You will be given a full paper, 5-hour paper, not this Saturday, following Saturday. Okay?
Okay, sir.
Okay, right. Okay, Lama, then fix the date. Huh? Right. Date fixed. That is 5th of August, Wednesday. Right? It will be 3-hour paper. Okay. Right. That's done. Let's say that. Right. Next one, Buddha, normal profit. Normal profit in the long run. Normal profit is earned in the long run, lamai. Right? Can you remember in the long run? Buddha, in the long run, can we see that both cost variable and fixed, or only one?
Only one.
Only one. What is that?
Variable cost.
Only variable cost, because all inputs become variable. So in the long run, Buddha, no, there are not two. I mean, not two the cost elements. Only variable cost. Total cost equals variable cost, lamai, or fixed part. Right. So remember, lamai, normal profit. When normal profit mean no, sorry, when the firm earns normal profit, firm earns normal profit. Price of the product, lamai, price of the product exactly equals price of the product equals average total cost. Price of the product equals average total cost. But remember that minimum expectation of entrepreneur, that normal profit part is covered, right? So no any intention to shut down the operation. They continue operation, no problem, even though economic profit is zero, because that minimum expectation of entrepreneur has been covered, no problem. So no any intention to shut down at this moment, lamai. Right? Okay. Normal profit from the diagram. Right. Normal profit. This is zero quantity PO cost. Okay, Dalamai. Sorry. What am I doing with that? This is average total cost. Average total cost. This is minimum point of ATC. Minimum point of ATC. This is marginal cost. Now, Lamai, price of the product exactly equals average total cost. Price of the product equals average total cost. Okay, the Lamai, it means price curve or the MR curve goes to the minimum point of average. This is a price or marginal revenue. Okay, the Lamai. So where's MR equal MC? This is MR, this is MC, this is the profit maximizing output Q1. Okay, the Lamai. Actually here you can see Buddha, if you go vertically upward Buddha, this is price of the product, assume 100 rupees. Here Lamai, average total cost also 100 Lamai. So there is no specific area of profit Lamai. There's no, I mean, we can't shade a specific area to show the profit, right? Did you get what I said, Lamai? This is the long run equilibrium. This is called long run equilibrium of the perfectly competitive firm. I mean, you don't show a profit area, Lamai. In this diagram, no profit area, as economic profit is zero. Right? If you calculate economic profit, Lamai, TR minus TC, TR and TC are equal, lamai, right? TR, TC equal, so economic profit would be 0. This is called long run equilibrium of the perfectly competitive firm. Yes, lamai?
Okay, sir.
Give me 1 minute. Oh. Right. Okay, next point. Next point. Right, graph is okay, lamai. Lamai, next to the diagram, write down there's a space. Next to the diagram, write down. At the Q, at the profit maximizing output level, at the profit maximizing output, what happens? Profit maximizing output, average total cost equals price of the product. Within bracket, write down, lamai. TR equals TC. TR equal TC. Comma. Economic profit is 0, lamai. Economic profit is right. That point also okay. Right. So that this page number 20. This is really important part. I've seen so many past paper questions. Page number 20. Profit behavior. Profit behavior of perfectly competitive market. So here we are talking about long run production process or long run equilibrium. Right. Read very carefully. In a perfectly competitive market, there are no barriers. Remember, Buddha, this is a really important point, right? There are no barriers to enter or exit the industry. Punara, do you agree or not?
I agree, sir.
Agree, Lamai. No barriers. Yes, anyone can come into the market. Anyone can come exit the market if they feel that they are not making the sufficient level of profit. Accordingly, when a firm in a perfectly competitive industry is able to, listen, Lamai, read that. When a firm in a perfectly competitive market or industry is able to earn supernormal profit. Supernormal profit means, yes, how is it expressed or how is it written using TRTC, Lamai? Are they equal, TRTC equal, or TR is greater than TC, or TC is greater than TR? What is that? Supernormal profit? Kalana, supernormal profit?
TR greater than TC.
Yeah, TR greater than TC. When in the short run, right? When perfectly competitive firm earns supernormal profit in the short run, where TR is greater than TC, what happens? Identifying this possibility, many new firms will enter the industry, Lamai. Many new firms will enter the industry Because this is type of motivation, lamai, right? Outsiders, right? This is very attractive situation, lamai, right? Outsiders see that existing firms in the perfectly competitive market are making profits, lamai. When outsiders, potential investors, those who are in outside and also who are interested in investing or in entering this market, see this profit Buddha, that exceptional situation in the perfectly competitive market, right? Increase in market supply and decrease in price. This process of new entrants will continue until such supernormal profit are eliminated, right? I'll explain this point, Lamai. Look at the board, look at the whiteboard. This is how it happens. Right. In the short run, Lamai, existing firms, this is plus one, existing firms earning supernormal profit. Earning supernormal profit. S&P mean Buddha supernormal profit. Supernormal profit. Existing firms earning supernormal profit. Buddha, how to draw, how to show this on a diagram? Supernormal profit. Price, quantity, or cost. Supernormal profit, Lamai. This is average variable cost. This is average total cost. This is marginal. Halana, when firm earns supernormal profit, price should be greater than average total cost, right? Yes. Am I correct or wrong?
Yes.
Yes. It means when firm earns supernormal profit in the short run, market price should be greater than price of the product now. Market price should be greater than price of the product. Like this. This is MRO price of the product now. Assume market price is 100 rupees. Punara, tell me, who decides this price, Pudha? Who sets this price 100 rupees? Yes, who sets this price 100 rupees? Anyone? I want answers. Lamai, who decides this price 100 rupees? Lamai? God. Halana, who decides this price, Pudha?
The firms.
Firms are price takers. They can't decide the market price.
Market demand and
Market
supply.
demand and supply process. Oh, Lamai. Right. Be careful. Market Lamai. This price is determined by market demand and supply process. This is the market equilibrium price. Kalana, can you remember? This is price of the product, quantity. This is market demand curve. This is market supply curve. 100 rupees is determined by market. That firm has to accept the price. This is market equilibrium. Market. This is firm's equilibrium. Kalana, are you okay with this? Punara?
Okay, sir.
Now, Lamai, existing firms in the short run earning supernormal profit. Supernormal profit. Then, Buddha, this is very attraction situation for outsiders. Then, Lamai, they try to come into this market. Kalana, tell me, can they easily enter into this market or not? Can or can't?
Can.
Can, because no barriers. Then lamai, new firms, huge, that is called huge inflow of new firms lamai. Right? More new firms come into the market, enter into the market. Enter into the market. Right? Existing firms earning supernormal profit. This is a type of motivation. Then what happens lamai? New firms enter the market, enter into the market, enter into the market. Are you okay with this? Now Buddha, no more firms in the market. Then lamai, Kalana, what happens to market supply now? What happens to market supply? What happens to market supply? Now more firms
Increase.
in the market lamai. Yes?
Increase.
Market supply increases. Okay, lamai. When more new firms come into the market, assume Buddha, in the short run only 50 farmers. Now when outsiders see that farmers earning abnormal or supernormal profit Buddha, other potential investors come into the paddy market. Then the number of paddy farmers increase in the market. Now assume Buddha, 150 farmers in the market. Now lamai, 150 farmers produce paddy. Then what happens to market supply? Market supply increases. Deepna, when market supply increases, what happens to market supply curve? Yes, when supply increases, what happens to market supply? Unit number 2. Yes. Ayo lamai. Deepna, but I don't expect perfect answers. I want you to answer what you know. That's enough for me. Yes. When market supply increases, the supply curve shift to the right side. Then what happens to this market supply curve? Market supply curve shift to the right side. This original market supply curve shift to the right side. Original market supply curve shift to the right side. Alana, why does market supply curve shift to the right side?
Because new supplies enter to the market.
Then more supply, more supply. Yes, more goods are being supplied to the market. Why can suppliers easily enter into the market within short period of time?
No barriers.
No barriers to entry. Okay, the lamai. Why are the new firms coming into the market? Because they see that the existing firms earning supernormal profit. That is a type of motivation. Then with the market supply increases, then lamai, when market supply increases, Punara, tell me what happens to market price now? What happens to market price? Alan, yes? Yes, Punara, yeah.
Decrease.
Decrease lamai. Now market price is would assume 80 rupees. When market price decreases, firms have to accept the market price. Now firm has to accept the price. So firms have to sell the product at 80 rupees. Now lamai, marginal revenue or price of the product is not 100 rupees. Kalana, how much is it? Now price is 80 rupees. Did you get what I said?
Yes.
Now my marginal revenue or price of the product has decreased. Firm hasn't done nothing. Okay, the lamai, right? This is not the fault of firms lamai, right? Firm is very innocent with that existing farm uncle in the market is really innocent. Okay, the point is lamai, problem means the market supply has increased, causing market price to decrease. Now farm uncle has to sell the entire stock at 80 rupees. Now lamai kalana, what happens to that abnormal or supernormal profit? Now is firm making supernormal profit or abnormal profit or normal profit?
Normal profit.
Normal profit. Then lamai, in the long run, then that supernormal profit becomes normal profit, right? When market supply increases, market price drops, market price decreases. When market price decreases, lamai, firms S&P supernormal profit reduces to normal profit, lamai, reduces to normal profit. That's why Buddha, we say in the long run, perfectly competitive firm earns normal profit. Perfectly competitive firms earn normal. Do you get what I said? Okay, the lamai. That is given in the tute. This is really important point, lamai. Punara, sorry, Kalana, Dipna, are you clear, Buddha?
Clear, sir.
Clear. If you want, you can write it down in your words. Buddha, that supernormal profit that does not reduce to economic losses. Huh? Remember that normally that researchers have revealed or found that supernormal profit decreases to normal profit. Supernormal doesn't become economic losses, no. Right? This is called firm's long run equilibrium. Firm's long run equilibrium. Then let me know if you're copying this down, no problem. If not, we can move on. Yes, Lamai? If you want to copy it down, I think it's better. I don't know. It's up to you. Alana, what are you doing?
Copying, sir.
Okay. And then copy it down. Dipna, you also can. In the short run, Puta, they earn supernormal profit. Existing firms earn supernormal profit. Then other firms can see this, that attracting the existing firms earn supernormal profit, right? Which attracts new firms into the market. Then Buddha, when market supply increases, market price starts to decrease. Then that supernormal profit gradually disappears. Will disappear little by little. And finally, firm will end up with normal profit. Punara network issue.
Yes, sir.
Okay. Then Puda, I explained that this part, this one, no barriers to entry part. Finally, Buddha, that in the short run, even though firms earn supernormal profit, the long run firm will end up with normal profit level because more firms come into the market, then market supply increases, causing market price to decrease. When market price decreases, anyway, we can't earn supernormal profit lama. That supernormal profit will gradually disappear. Finally, the normal profit will be for the firm, the long run. Now remember, that is not the fault of the firm. Anyway, everyone wants to earn supernormal profit, right? I'm going to ask a very creative question. If you can please answer. So even though price of the product drops, market price decreases, can't firm earn a supernormal profit. Even though market price drops, when market supply increases, can't a firm earn supernormal profit? I'm not going to answer that question, Buddha. You can take off. If I explain that point, then you will mix up everything. No. Let's take this idea first. Right, shall we move on? Need more time? Alana, Dipna?
Done, sir.
Done. Dipna? Dipna? You okay, Buddha? Shall we move on? Last part.
Done, sir.
Okay, right. Now, Lamai, assume one firm in the short run, perfectly competitive firm earns economic losses. Starts with economic losses. Economic losses. Okay, the Lamai. Existing firms earning economic losses, Lamai. Earns economic losses. Not supernormal profit. Now short run firms, perfectly competitive firm, earn economic losses. Economic losses. Kalana, what is the relationship between TR and TC? Economic losses.
EC greater than TR.
TC greater than TR. Price, quantity. This is average variable cost. This is average total cost. This is minimum points of ATC and AVC. Now, Lamai, that firm is making economic losses. Economic losses mean price of the product is lesser than average total cost, or TR is lesser than total revenue. Then Lamai, this is the market price. This is price, so MR of the product. Okay, the Lamai. Assume this price is 100 rupees. Kalana, tell me who decides this price?
Demand and supply.
Market demand and supply. This is market demand curve. This is market supply curve. Supply. Okay, this is equilibrium price. Assume that's 100 rupees. Now what happens, Lamai? What happens is existing firms earn economic losses. Then Buddha outside, economic losses. Tell me, Buddha, are existing firms encouraged or discouraged now? They are interested, or they are, interested or disappointed doing business now, because they are making losses. But like revenue is not enough to cover average total, the total cost. That's enough to cover total variable cost. That's something else. Tell me, whether it's very attractive situation, or there is a situation where firms are demotivated. Economic losses, Dipna? Yes. Will firms existing firms be motivated or demotivated, Lama? Kunara?
What was the question, sir?
I ask, now firms in the short run, earning economic losses. Total revenue is not enough to cover total cost. Total revenue is not enough to cover total cost. My question is, will existing firms be motivated or demotivated now? Demotivated. Then Buddha, that existing firms will exit the market now. Why? They are not making the enough profit, Lamai. So existing firms will leave the market, Lamai. But is next, due to these economic losses, existing firms exit the market. Beautiful. Existing firms exit the market. Kalana, tell me, Buddha, can they exit the market easily? Can they leave the market easily? Yes or no?
Yes.
Yes. Why?
There is no barriers to
No
exit.
barriers to enter or exit now. No barriers to exit. So anyone can leave the market, Lamai. Then so many firms in the short run, Buddha, will leave the market due to economic losses. Then Kalana, tell me, when many firms leave the market, what happens to market supply? What happens to market supply?
Decrease.
Decrease, Lama. Then Buddha, market supply get decreased. Kunara, tell me, when market supply decreases, what happens to market supply curve?
Shifts to the left.
Left side, Lama. Yes. Market supply curve shift to the left side. Same too. Dipna, tell me, what happens to equilibrium price now? Market equilibrium price. Yes. What happens to market equilibrium price? Dipna?
Increases.
Increases, Lamai. When market price increases, Kalana, tell me what happens to that economic loss situation. When market price is 120 rupees, Lamai. Now MR is 1, or MRO price of the product increases up to 120, making normal profit for the firm. You get what I said? That economic losses gradually disappear, and finally the firm will end up with earning normal profit. Not more than that, normal profit. Okay, then market supply decreases, then what happens? When market supply decreases, market price of the product increase. When market price increase, what happens? Firms economic losses improves. economic losses improves to normal profit. Normal. We want, Buddha note has been given, but I think this is very clear. Both diagrams, Buddha, this is called market equilibrium. This is called market equilibrium. This is called firm's equilibrium. Called firm's equilibrium. Lamai, this question, yes, Buddha? Yeah. This question was tested 2 times. 2023, no, 24. Very creative question there. 2024 A-level paper. Or 8 or 10 marks. Let me know once you're done. How interesting it is, Lamai. You know. And finally, that's why Buddha we say all perfectly competitive firms earn normal profit in the long run. Even though short run profit is supernormal, firm will end up with normal profit in the long run. Even short run perfectly competitive firm earns economic losses in the short run. That firm also will end up with normal profit in the long run. Okay, that is the idea. Let me know once you're done. Lamai, let me know once you're done. Take time, no problem. Let's get it done. No issue. Take time.
Done, sir.
Dipna. This second situation is called outflow of existing firms. Outflow of firms. First one is inflow of firms. Remember, Buddha, that when existing firms earns economic losses in the short run, more firms will leave the firm. But remember that exit will stop when firm earns normal profit, right? Not less than that, Lama. When existing firms earn normal profit in the long run, that the exits will stop, right? No firms will leave the market. when that economic losses comes to the normal profit. Okay, right. Dipna, Punara, need for time?
Done, sir.
Done.
And sir.
Okay, Buddha, that's enough today. I have very small part to complete. That is supply curve of perfectly competitive firm and producer surplus. We have discussed producer surplus, Buddha, but we can discuss producer surplus using this ABC and that graph as well. Then factor market analysis, Buddha, most probably by next week. I mean next Sunday, I will be able to complete the session. There's a small part for the factor market analysis, but it's not the detailed analysis in your yeah. Then we can start after the exam, Buddha. We can start new lesson. That is right. Okay. That's enough today. See you next day, Buddha. Thank you for coming. Good night, everyone.
Thank you, sir. Good night.
Thank you, sir. Good
Bye
night.
bye. Good night.
Thank you, sir.
Recording.